Hi everyone, we are going to talk about a very famous investor today, Howard Marks. Howard Marks co-founded Oaktree Capital in 1995 and he's currently chairman of his company. And also, he is very well known and famous for buying debt or asset of troubled companies at cheap prices. But he is probably more famous for his investment note, which he has been writing for more than 30 years since 1990s. Before we start, there is one thing we should keep in mind. Howard Marks is not really the type of investor who is picking individual stocks. He's more a person who reads the market cycle and moves capital based on where we are in that cycle. So his main business is in private areas like troubled debt. So US listed stocks shown in 13F filings are not really his core business. So today we are not looking at his 13F to simply copy which stocks we bought. Instead, we are using it as a clue to understand how he sees the overall market. After that, we'll look at his memos and see how the two connect. If we look at Howard Marks' portfolio performance, it looks actually very strong. Compared with other institutions, his estimated recent 1-year return is around 62%, 3 years is 82%, and last 10 years average return was 21.56%. During the same term, S&P 500 was 15% range and Nasdaq 100 was 22%. So basically, his performance is almost similar with the Nasdaq without big tech companies. If you think during a 10-year period when big tech basically carried the market, his performance looks great without big tech. But again, this is only based on 13F filings. Oaktree's main business is still in private market, like troubled debt, and those holdings do not show up in 13F filings. So please keep that in mind. Now let's look at 13F. At the end of the first quarter, Oaktree had 51 positions. They bought 12 new names and fully sold around 13 names. So about 25 positions changed in one quarter. That tells us something important. Howard Marks is not only sitting still, he's still checking market cycle and moving capital when he thinks the setup is changing. The most interesting thing is there are no major tech companies in his portfolio. Nvidia, Alphabet, Microsoft, and Meta are not big positions in this portfolio. Instead, the number one holding is Tom, a shipping company, at around 16%. The second holding is Expand Energy, a natural gas company. Another major holding is Angola Gold Ashanti, a gold mining company. He also owns names like Get Motion, an auto parts company. So the big AI stocks that pushed the market higher over the last few years are almost missing from his portfolio. And this is not just one quarter. If we look back over the last few quarters, his top holdings have mostly been shipping, energy, gold, cyclical stocks, and deep value names. Big tech has not really been there. His biggest position, Tom, was reduced a little last quarter, but it came back as the top holding again in the first quarter. He also sold around 70 million worth of Tom in first quarter, but it is still number one. So he's not chasing the most popular names. He seems to be staying with areas that are cheaper and less crowded. If we look at what he bought and sold, he reduced some healthcare names, but overall we can see more money moving toward South America energy companies. For example, he added more to YPF, an energy company in Argentina, that fit his style. His main business is troubled debt. So he's used to looking for broken, cheap, or ignored assets. And we can see the same mindset in his stock portfolio. So overall, this is clear a portfolio that says far away from AI. But some people may ask, AI is so strong right now. Why would he stay away from it? To answer that, we need to look at his recent memos. Howard Marks is famous for his investment memos. These memos show how he thinks about the market. Warren Buffett also said he reads Howard Marks' memos. So if we connect his recent memos and interviews, we can see his view more clearly. The first memo to look at his bubble memo from January 7th, 2025. The key point was that he was watching for bubble signs. The date is interesting because one of his most famous memos was published exactly 25 years ago on January 7th, 2000. That memos was called bubble.com. It became famous because it warned about the dot-com bubble. So 25 years later, on the same date, he talked about bubbles again. That was not random. He was clearly looking at today's AI boom through the dot-com bubble's lens. In that memo, he pointed out 4 warning signs. First, the market became too optimistic after late 2022. Second, AI excitement started spreading into many other tech areas. Third, the market became too dependent on the small number of big tech stocks. And fourth, index fund kept putting more money into the biggest and most expensive stocks without asking whether the price was fair. Howard said a bubble is not only about numbers, it is also about market mood. In other words, when investors become too excited, too confident, and too willing to pay any price, that can be bubble sign. He did not say clearly this is a bubble, but writing this memo on the same date as his old dot-com warning was clear signal. He's not comfortable with the current AI excitement. Then, in December, he wrote another memo called "Is this a bubble?" In that memo, he was still careful. He did not say AI is definitely a bubble. His point was simple. Nobody can know for sure. So investors should not bet everything on one side. But he also said investors should not completely leave the market. AI could still be a major technology shift. So the idea is not sell everything or buy everything. His view is more balanced. Do not go all in or all out. Stay careful. But he made one key point very clear. AI technology being real and AI stocks being fairly priced are two different things. AI can be real, powerful, and useful, but that does not mean every AI stock is cheap. So investors may want some AI exposure, but they still need to be careful about price. A few months later, in February 2026, he wrote another memo about AI moving very fast. In that memo, he added 3 important ideas. The first idea is speed. He said AI is spreading faster than almost any past technology. When computers first came out in 1945, some people thought the world might only need few computers. Adoption was slow, but AI is spreading much faster. That means AI could create effect we have not seen before. The second idea is a circular revenue. This means AI companies are often buying from each other, investing in each other, and helping each other create revenue. That can support growth for a while, but Howard said a real demand has to come from final users. Consumers need to pay for tools like ChatGPT. Regular companies need to pay for AI tools in their business. If real outside demand does not grow enough, the AI revenue story becomes weaker. The third idea is also very interesting. Howard used the cloud, the AI model from Anthropic, to help explain AI in his memo. But then he pointed out one problem. Cloud could explain why AI is real. It could explain why demand is growing, but it did not answer the key investment question. Are AI asset prices fair? That supports his main point again. The technology can be real, but the price can still be wrong. Howard also talked about what AI still cannot do well. AI is good at finding patterns from past data, but it may be weak when there is no past data. It may also be weak in areas that need human judgment, taste, and common sense. Most importantly, he said AI has nothing to lose. People fear losing money. AI does not. That means AI may not understand risk the same way humans do. Then in April, Howard gave a more direct message on CNBC. He said investors keep buying every dip, but in his view, the market is still not cheap. Investors are buying because expensive stocks fell a little. That is not the same as buying cheap stocks. A real bargain usually comes when people are scared, negative, and trying to get out of the market. That is when assets can become truly cheap. But right now, many investors are waiting to buy every small dip. to Howard Marks, that shows the market mood is still too optimistic. If investors keep buying every 5% or 10% drop, they may end up paying high prices again and again. If we connect this point, January, December, February, and April, his view becomes clear. He did not suddenly change his mind. First, he said he was watching for bubble signs. Then he asked if AI was becoming a bubble. Then he looked deeper at AI speed, circular revenue, and valuation risk. Finally, he became more direct and said this market is not on sale. Other well-known investors like Stanley Druckenmiller and David Tepper have also become more careful recently. They may still own some AI names, but the tone has changed. Many great investors are no longer acting like AI is risk-free. To summarize, Howard Marks seems to think the overall market is expensive. He's staying away from the most expensive AI big tech names. Instead, he's putting money into cheaper areas like cyclical stocks, resources, shipping, energy, gold, and emerging markets. He has also started using put options for downside protection. So, how do we know if Howard is right or wrong? I think there are three things to watch. First, watch the real end user demand. If AI revenue starts coming more from real customers, that would be a good sign. That means consumers paying for AI tools and companies paying for AI software in daily work. If this real demand grows fast enough to support big tech spending on chips and data centers, then Howard's concern may become weaker. But if the AI money loop stays too high, that is a warning sign. Second, watch the gap between technology and price. We need to see whether earnings grow fast enough to support stock prices. If profits grow and valuation multiples come down naturally, the bubble risk becomes smaller. But if stock prices keep rising faster than profit, then Howard Marks' warning becomes more serious. Third, watch market mood. Howard says bubbles are about psychology, so we should watch things like the put-call ratio, the VIX, and money flowing into or out of funds. When the market finally moves from confidence to real fear, then may be when real bargains appear. But one thing is important. These indicators will not tell us the exact market top or bottom. Howard is not saying we should perfectly time when to sell or when to buy. His point is about risk level. Are we in a high-risk market or low-risk market? That is the question. So, I would not read Howard Marks as making a short-term prediction. I would read him as giving us guide. He's showing how to think about risk, price, market mood, and discipline. That is why I really like Howard Marks. I also really like his book, The Most Important Thing. If you have time, I highly recommend to read this book. It's a great book to read. It helps investors build a better mindset, especially around the risk and market cycle. Thank you for watching my video today. If this video was helpful, please like and subscribe to the channel. I will see you in the next video.